Welcome back, everyone, to NYU Grad's Daily Podcast. It's Monday, October 9th, recording this after market hours. Hope you had a good day today. Let's jump right into the breadth numbers today. We had 78 new highs, but we still have a very concerning number of new lows, 407 on the day, on Monday. We had still a very high number of shares trading below the 50-day moving average. It's 80%. And we have 68% of shares trading below the 200-day. Still very concerning. 58% of shares were advancing today versus 37% declining. And pretty much all sectors were green. Financials were down just a hair, but energy led. Um, Obviously, with all the conflict in Israel and Gaza, energy was up very big, oil was up very big, industrials and defense sector stocks were up also big, real estate was bouncing, utilities was up almost 1%, but technology, while green, did not lead up. When you take a look at kind of what was leading in the day of the Magnificent Seven, it wasn't that bullish. They were mostly green. 5 of 7 were green. Microsoft was up 0.78%. Apple was up 0.84%. Google was up a half a percent. Amazon was up a quarter percent. Nvidia, though, was down 1%. SMH and the semiconductors were down in sympathy with the conflict because Israel is a big player in the semiconductor group. Um, Taking a look at healthcare, they too were fairly positive today. Like you had Eli Lilly up 1.1, J&J up half a percent, Amgen up 1.5%, Merck up 0.6%. And then, as I mentioned, the leading sector was energy. Taking a look at some of these individual names, you had Exxon up 3.5%, which is huge for their market cap. Chevron up 2.7%. So yeah, like you had a lot of energy shares that were up. Um, you know, as I mentioned earlier, this is still concerning me that in any up move day, we still have more new lows than new highs. Until I see that change, I'm going to be skeptical. What I need to see um, to believe in a reversal, to potentially go long, right, is one, weaker yields, two, a stronger yen US dollar pairing, which means a stronger yen, a weaker dollar, a weaker crude oil price under $80, and I would love to see 51% of stocks trading above their 50-day moving average. And then the last one is more new highs than new lows every day. So I report on breadth every day, and lately, whether the markets are green or red, they're the new low number, like on Monday, 407 new lows versus only 78 new highs. Like, we need to see that change. Um, until then, this is for me going to be considered a bounce into the 50-day moving average. If you take a look at the S&P 500 index or SPY, however you like to cut it, I'll post both charts in the show notes. So prior to this sell-off, everybody was talking about the cup and handle on the QQQ or NASDAQ and the S&P 500. And with the recent sell-off, we've kind of broken down from that cup and handle, but prices are trying their best to go back into a channel where the handle kind of broke down. So we are back testing to the upside, the falling 50-day moving average right now. And if you look at the chart of the SPY, yeah, we can definitely get back up to the 50-day moving average. At today's close, the 50-day is at 439, and we closed at 432. So we're 6 points away from the 50-day moving average. Great. We'll probably get there on Tuesday, but I want to see how prices react once we get there. Will it pierce through and fail and tuck its head in and just crash? Or will we poke through above the 50-day, create a new balance area where we're kind of carving out support and a new support area where we don't break down, and then use that as a launching pad higher into the end of the year, like everyone is saying, Q4 is going to be great and bullish. So that's what I'm looking for at the end of the day, at the end of the week. Um, I just need to see more cards come out of the deck. Um, Something that I, kind of want to also point out, the rally has been pinned on many different things. On Friday, it was, I hate to give credit to the Fed, but there were Fed heads, Fed officials on Friday as well as today that basically was alluding to the fact that the 10-year yield rose so much in the past year that the yields increasing technically wasn't Jerome Powell and the Fed, it was just natural forces. And because the yields rose so much, it did its job. The yield did the job for the Fed. Thus, they may not need to raise interest rates anymore. Hypothetically, the innuendo is, hey, maybe they can start cutting and not raise rates and not stay high for longer. That dovish comment is kind of what ignited this rally. So again, we have people dying overseas in a war conflict. We have all of these macroeconomic data that's telling us that there's a recession ahead with the inverse yield curve, and headline risk of either politicians or Federal Reserve members are yo-yoing this market. And that is why I'm skeptical. I want to see other sectors lead, and I want to see breadth. I want to see hundreds of stocks participate, not just seven. Um, that's kind of all I have today, guys and gals. You know, it was a bullish day, no doubt about it. But let's see what happens when we get, if and when we get to the 50-day moving average on the indices and how that reacts. I'll see you guys on the next podcast. Later.